The 10 largest companies in the world represent over $15 trillion in market capitalization. They're the giants that dominate indices, drive market returns, and shape the global economy. But when you look at their forward PE ratios, what investors are paying for future earnings, the valuations tell a fascinating story about market expectations and risk. Forward PE ratio divides stock price by expected future earnings per share. It answers one question: how much am I paying for each dollar of profit this company will generate? A 35x multiple means you're paying $35 today for $1 of earnings next year. That's expensive unless growth justifies it. A 16x multiple is cheaper, but maybe growth is limited. Let's decode what the market is telling us through these valuations. Broadcom leads at 35x forward earnings, the highest multiple in the top 10. Why? AI infrastructure. Broadcom makes the networking chips that connect thousands of GPUs in AI data centers. As companies build AI compute clusters, Broadcom profits. The market is pricing in years of AI-driven growth. That 35x says investors believe Broadcom's earnings will grow fast enough to justify today's price. It's expensive, but if AI infrastructure spending continues, it could be reasonable. Amazon, Alphabet, and Apple cluster around 31 to 32x. Amazon's multiple reflects AWS cloud growth, still expanding at 20% plus annually. Alphabet's 31x is interesting because they have a search monopoly printing cash, yet the market isn't giving them a higher multiple. Maybe regulatory risk, maybe maturity concerns. Apple at 31x is paying for the services ecosystem, subscriptions that grow even when iPhone sales slow. These are premium multiples, but for companies with proven moats and scale. Microsoft at 28x is actually the cheapest of the mega-cap tech stocks. Azure is growing, AI integration is driving enterprise adoption, and Office 365 provides recurring revenue. A 28x multiple for Microsoft's quality and growth is surprisingly reasonable in this group. NVDA at 26x is shockingly low given AI hype. This is the company that makes the H100 GPUs powering every major AI lab. Why only 26x? The market is pricing in growth deceleration. NVIDIA's growth has been explosive, but at some point demand normalizes. Even though they dominate AI chips, the multiple suggests investors expect maturity. This could be opportunity, or it could be the market being realistic about sustainability. TSMC, also at 26x, makes sense. They manufacture everyone's advanced chips. Apple, NVIDIA, AMD, they have a manufacturing moat that's nearly impossible to replicate. But chip fabrication is capital intensive with cyclical demand. The 26x multiple acknowledges their dominance while respecting the cyclical nature of semiconductors. Berkshire Hathaway at 22x is Buffett's conglomerate. Insurance, railroads, utilities, Apple stock, diversified but slower growth than pure tech. The 22x reflects stability and quality without explosive growth potential. Meta at 21x is the cheapest big tech stock on this list. 4 billion users across Facebook, Instagram, and WhatsApp, dominant in social advertising. Why so cheap? Metaverse spending concerns, regulatory pressure, competition from TikTok. But fundamentally, Meta prints money from ads. That 21x multiple could be opportunity if you believe in Zuckerberg's vision, or it could be the market correctly pricing in risks to their business model. Saudi Aramco at 16x is the lowest multiple by far. Why? It's an energy company, not a tech company. Oil prices are cyclical. Growth is limited by geology and global demand. But Aramco generates massive free cash flow and pays huge dividends. That 16x is cheap because it's a different business model. Mature, capital return focused, commodity exposed. It's not better or worse than tech, just different. Here's what these multiples tell us about market expectations. Tech giants at 26 to 35x are priced for continued growth. The market believes AI, cloud, and digital transformation will drive earnings expansion for years. Berkshire and Meta at 21 to 22x get moderate multiples, growth but not explosive. Saudi Aramco at 16x is priced for maintenance, not expansion. These aren't random numbers, they're the collective wisdom of millions of investors assessing growth potential, competitive position, and risk. The question isn't which multiple is right or wrong, it's whether you agree with the market's growth assumptions embedded in each price. 10 companies, $15 trillion. Multiples ranging from 16x to 35x. Each one represents a different bet on the future. High multiples aren't bad if growth delivers. Low multiples aren't good if businesses decline. Warren Buffett said, "Price is what you pay."